Robert. Well, I mean, where do we stand right now in terms of like transactions? I mean, relative to what it was in the past, are we doing worse, better, what?
So over the last 30 years, it's ranged from 4 million homes sold on an annual basis to 7.2 million homes. The mid-cycle is around 5.5. Last year was 4.09, the lowest since 1995. And the population is more than 20% bigger than it was in 1995. So last year was a really bad year. Last month, to share what the current market is, was 4.1 million homes on a seasonally adjusted annual rate basis, which is still very low. We started the year, we thought there were going to be 6 rate cuts. The spring turned into a market where there's an outlook of only 0 to 1 rate cuts. And so it is not a great market, but it is moving, and last year does seem to be the bottom.
I am curious, when we talk about rates, I mean, that really changed the complexion of affordability, you know, going from basically near zero Fed funds rate to 5+% right now. If we do get a drop in rates at some point, in theory we would, I mean, how much do we really need to see that would have an impact, A, on the mortgage rate, but to the point that it would spur maybe greater transaction activity?
And so I think 6.5%, right now we're at around 7%, 6.5% would feel good. There'd be nice movement. I think we'd be at 4.5 million, 4.6, 4.7. But if you get below 6, 5.999, that'd be marketing magic, and it would tell, you know, every agent would go out there, share with their buyers that this is a great time to buy, particularly after a 2-year period that reached 8+% mortgage rates.
Does that spur people to actually put their homes on the market to help that affordability issue?
Yes, so we already have more homes on the market, and yes, that would bring more. But if you look at the data, over the last 31 weeks, each week we saw more inventory than we did in the prior week. And that's one of the reasons why, and you saw the new homes data, where year over year, new home sales are down. That's because they're not the only game in town right now. The existing homes brought new inventory to the market this spring.
What is have the prices come down enough to compensate for the higher rates? Like, I feel like the gap has been super wide and it's slowly been coming in. Are we there yet?
So prices right now, I'm sorry to say, are at an all-time high.
Yeah, we're not there yet.
We're not.
How much more do we have to re-rate to get there?
Well, the one silver lining on a price side is that right now in the market, 37% of all the homes that are on the market have had a price drop, which seems like buyers are finally starting to push back on the upper bounds of affordability. And that's more homes with a price drop in the month of June than any time in the last 10 years.
I'm curious about the geography of all this. Are you seeing differences depending on what part of the country you're in?
Yes. So I think the markets that saw some of the biggest improvements are starting to pull back the most now. So that's Florida. That's Texas.
Texas, yeah.
And some of the markets that saw some of the recent drawbacks, like San Francisco, are all starting to move forward. Now they're helped with, they have NVIDIA, right? And NVIDIA, there are a lot of people that work in tech.
They've got a lot of new millionaires.
They have a lot of new millionaires.
Yeah, they're going to be looking for a home sometime soon. But it gets to the idea too. I mean, we talked a lot about some of the demographic changes, people finding new places to live during the pandemic, like Florida, Texas, lower cost areas. Are those shifts permanent, or do you think that's going to somehow, these people all cycle back to wherever they originally came from?
I think the majority will cycle back. I think it accelerated some people that were going to move to Florida anyway in 1, 2, 3, 4, 5, 6, 7, 8, 9 years. Maybe they moved a little earlier. But we are seeing people come back. I mean, we're here in New York City. You can see this. The offices are really starting to come to life, and people are asking people to come back to work.
So I was interested in KKR. There was a Wall Street Journal article out that KKR actually put a lot of money into rentals because they just don't see the kind of supply coming online, that we will always be short homes, and that the rents are going to start to appreciate really fast. Would you agree with something like that?
Yeah, I would agree.
Okay.
KKR, a very smart company, wouldn't disagree with them on that. But there's not enough inventory on either side, on rentals or in sales. We are seeing the rent inflation starting to plateau on a year-over-year basis, which is positive, and that should come into the data and the CPI numbers in the months ahead.
So why are rents plateauing? Is it just we just reached the amount that people are willing to pay, or what's your read on that?
Well, I think it's reached the amount that people are willing to pay, one, but also there's more inventory that's coming on the market. People have been building, they have been converting from office into rental. There's more supply of rentals and sale units, as well as new developments that have come online.
With regards to the new developments, so I mean, I know builders, particularly for these gigantic developments, they're looking, 10 years out in the future. They're not as concerned about whether the Fed cuts 25 basis points over the next couple of meetings here. But as they sort of do this long-term planning, are you seeing a big difference in what they're planning? I mean, meaning like before, I feel like before the pandemic was all about these big multi-use buildings. You had to have, a mixture of office, a mixture of residents, and of course retail on the bottom. Is that still kind of the playbook?
I think what I'm seeing more from developers is more pure play.
Pure play.
Less office, more pure play
Yeah.
with a wonderful restaurant to bring the traffic and to make it feel high end.